Hello, everyone, and welcome back to the Deep Dive. I hope you are having an exceptional week and are ready to tackle a serious discussion on a true cornerstone of global consumer discretionary investing. Today, we are breaking down one of the most recognizable yet fundamentally challenging global pure players, the century-old beauty giant, L'Oreal. For generations, they have defined what premium and mass-market beauty looks like, leveraging, unmatched brand equity and scientific leadership across the entire spectrum of consumer needs.
That's absolutely the crux of it. On the surface, L'Oreal is widely viewed as the definition of a structurally sound business. It's got an incredibly durable competitive advantage, an economic moat, and that's what justifies its typical premium valuation.
And we're talking a PE multiple currently sitting around, 32 times?
Around 32x trailing earnings, yeah.
Right.
But for the long-term, multi-decade investor, the central question for us is whether that price implies a risk that the market is currently too comfortable ignoring. Specifically, is a century-old, massive organization structured, organizationally and technologically, to successfully transition and survive the coming wave of digital personalization and sophisticated biotech disruption.
So it's a quality versus cost argument.
Exactly. We are here to analyze the quality versus the ultimate cost.
That is a massive question, one that requires us to really dig deep into the operational and financial fundamentals. And before we get into those details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform that can handle global equities, sophisticated trading, and reliable research is absolutely key. We consistently use and recommend Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up and fund an account.
So you get a bonus and support the channel at the same time. That link is right there in the description below.
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to ensure you catch the next deep dive is to subscribe and like the video.
It truly helps the channel grow.
It really does. And if you have any questions regarding the company, please drop them in the comment section.
Perfect. Now let's get into it. We're starting with the foundation, the L'Oreal business model. We need to understand exactly what they sell and why people continue to buy it year after year, recession after recession.
The beauty of this business model, and yes, I apologize for the pun, is how exceptionally straightforward and fundamentally durable it is. At its core, L'Oreal is a pure play on human psychology and, our deeply ingrained desire for self-expression.
So they're not really selling makeup, they're selling confidence.
Precisely. They generate revenue by developing, manufacturing, and marketing a diverse portfolio of beauty products. But the durability comes from the fact that beauty consumption is an emotional, self-esteem-driven necessity for so many people.
Right.
It functions less like a classic cyclical retail item and more like a defensive consumer staple.
That non-cyclical resilience is absolutely key to their valuation, and it's reinforced by some really powerful multi-decade structural tailwinds. And these aren't just one-off trends. These are like demographic and economic tides ensuring their endurance over the next 10 to 20 years.
So what's the first one?
Well, the first and most straightforward is global population growth and urbanization. Every year, the sheer number of people needing and wanting personal care products just increases.
More customers. Simple as that.
Exactly. And as populations consolidate in major urban centers, especially in massive markets like India and Southeast Asia, consumer habits become more standardized.
Which makes them easier to target.
Yes, easier to target with efficient, scalable, mass-market campaigns, which plays perfectly to L'Oreal's strengths.
And the second trend is even more critical for the margin structure we're going to discuss later, rising affluence in emerging markets.
This is the premiumization story.
Absolutely. This isn't just about more people buying shampoo. It's about a massive global shift where billions of people are moving up the economic ladder. They are shifting from purchasing basic, unbranded, or local products to premium, international, and high-end luxury items.
And L'Oreal is waiting for them at every step.
Critically, yes. They own brands at every single point on that economic spectrum. So they capture that consumer regardless of whether they are making a mass-market entry purchase or upgrading to a luxury skincare routine.
They're structurally positioned to benefit from wealth creation basically anywhere in the world.
That's the idea.
And finally, the most fundamental trend ensuring resilience. The enduring human desire for self-expression, confidence, and well-being.
You mentioned this before.
Right, and it's why the category is so resilient during economic stress. People may postpone buying a new car,
Sure.
but they will still buy a new lipstick or a high-quality moisturizer because it offers an immediate, affordable psychological uplift. L'Oreal's entire architecture is built to capture this.
And that architecture is what we need to break down. The four main divisions that cover literally every consumer aspiration, ensuring they offer, as they say, beauty for each.
Let's start at the base.
You start with consumer products. This is their volume and distribution engine, the mass market. We're talking giants like L'Oréal Paris, Maybelline, and Garnier.
The brands you see in every supermarket.
Exactly. These brands provide scale, cash flow, and global reach, allowing them to dominate supermarket and pharmacy shelves worldwide. The margins here are respectable, but they rely heavily on efficient supply chains and massive marketing spend.
Then you move up the aspirational ladder to L'Oréal Luxe.
Right. This is their high-margin, high-end portfolio. It covers skincare, makeup, and perfumes. Think Lancôme, Kiehl's, and Armani Beauty.
So this is the segment that really captures that emerging market wealth we talked about.
It is. It's crucial for that. And it offers significant pricing power rooted in prestige and exclusivity. A good portion of the R&D we're going to discuss is designed specifically to feed proprietary ingredients into this high-margin luxury engine.
Okay, so that R&D is key. And that brings us to the next division, which feels like a bridge between the two.
And this is where their sophistication truly shines with the Dermatological Beauty division.
CeraVe, La Roche-Posay. These are huge right now.
Incredibly fast-growing. These are the science-backed, physician-recommended brands. And the segment is booming because it blends the trust of medical efficacy with the accessibility of mass distribution channels.
So it feels like a treatment, not a cosmetic.
That's the perception. And it drives margins that often rival Luxe because consumers see them as necessary treatments, not optional indulgences.
And completing the circle, you have the professional products division.
The salon business.
Right. This is a segment for hair salons and high-end services, with brands like Redken and Kerastase.
And this division is important because it ensures L'Oréal maintains control and insight into the service side of the beauty industry. It cements their control over the entire supply chain and consumer journey.
Especially in premium hair care.
Yes. The goal, ultimately, is if a consumer upgrades their spending, they almost invariably upgrade within the L'Oréal ecosystem, thanks to this comprehensive portfolio.
They've got you surrounded.
That's exactly right. And that brings us to the core of the competitive advantage. The economic moat.
Right. What are the intangible assets that make this company so difficult to compete with, and why do they generate superior returns year after year?
Well, it fundamentally starts with scale.
But not just physical scale, it's the scale of the brand portfolio.
Explain that.
We're talking about 37 complementary international brands. Just imagine that for a second. 37 different franchises, each with its own niche, its own history, its own consumer base.
Covering every price tier, every channel.
Every demographic. This systematic grid approach means they are inherently resilient. If, say, traditional mass market makeup faces headwinds.
Like from social media trends.
Exactly. They can shift investment immediately to high-growth, high-margin dermatological skincare, where CeraVe is dominant. This diversification minimizes idiosyncratic risk.
Okay, so the portfolio is one pillar of the moat. What's the other?
The real engine.
The intellectual property moat. It's the research and innovation, or R&I. This is where L'Oréal differentiates itself from every generalist competitor.
Their commitment here is just staggering.
It is. They're investing over €1 billion annually and employing approximately 4,000 researchers globally.
4,000 scientists.
In chemistry, biology, formulation science, and now data science. Think about the barrier this creates. For any smaller, more agile competitor to even attempt to match this depth of continuous scientific discovery.
It's impossible.
Not just in one category, but across hair, skin, and makeup. It would take decades and just astronomical amounts of capital.
So this R&D capacity lets them generate proprietary molecules, things that are actually different.
Fundamentally different, or at the very least, patent protected. Their products aren't just copies.
And we see that €1 billion R&D expense translate directly into a measurable economic benefit. Pricing power.
Yes.
The dermatological division is the textbook example here. When you buy La Roche-Posay or CeraVe, you're not just buying a moisturizer.
You're buying a product that carries the imprimatur of medical or scientific validation.
And people will pay up for that.
significantly. The consumer is willing to pay a premium, often 20 to 50% more, for a product that's perceived as a medically validated high-efficacy solution.
Compared to just a generic brand.
Exactly. This willingness to accept a premium price, anchored in genuine brand trust and science, is the ultimate proof of a durable, wide competitive advantage.
It's not just marketing fluff.
It's R&D converting into reliable, high-margin revenue streams.
So this means we can't look at L'Oreal as just a collection of separate businesses. We have to frame its strategy using a compounding loop. It's the synergy that matters.
Right, good.
The loop starts with that continuous billion-euro investment in proprietary science and R&D.
Huh?
This generates patented, high-efficacy products. Those R&D-backed innovations are then efficiently leveraged and distributed across their massive 37-brand portfolio, hitting mass, luxury, and pharmacy channels simultaneously.
So they maximize the return on that initial R&D investment.
They maximize it across over 150 countries, generating superior margins, which are then immediately plowed back into the R&D budget for the next cycle of innovation.
It's a self-reinforcing virtuous loop.
And it constantly widens the gap between L'Oreal and everyone else.
That concept of compounding advantage is absolutely crucial for justifying the valuation. But to truly appreciate that advantage, we need to benchmark them against their direct competitors.
Let's do it.
The gap L'Oreal has created really stems from their singularity of purpose. Let's start with Estée Lauder.
Their biggest rival in luxury.
Right. They are L'Oreal's most serious competitor in the high-end space. Estée Lauder is hyper-focused on prestige and luxury, especially skincare and fragrances, with an extremely high concentration in the Asian market.
Which has been great for them, but also a risk.
A huge risk. While they are a formidable luxury player, L'Oreal's key advantage is its sheer breadth and diversification. If the luxury market slows, or if the Asian market faces geopolitical headwinds, L'Oreal can rely on its massive, defensive consumer products division or the high-growth dermatological segment to maintain stability.
So Estée Lauder is more of a high-wire act.
By focusing almost entirely on the highest end, yes, it exposes itself to greater cyclical risk.
And then you look at the generalist, fast-moving consumer goods players like Unilever and Procter & Gamble.
The conglomerates.
Right. Unilever is a massive conglomerate covering food, home care, personal care. P&G is also diversified, focusing heavily on hair care with brands like Pantene, but beauty is a smaller piece of their pie.
The difference is focus and institutional priority.
Explain that.
Because beauty is not the sole focus for Unilever or P&G, their innovation cycles within the beauty-specific space tend to be slower.
Their attention is divided.
Their internal scientific talent pool and capital allocation are split across dozens of unrelated categories. L'Oreal is a beauty pure play.
A century of obsession.
Exactly. Their century-long singular obsession with beauty ensures they maintain superior depth of insight, attract specialized talent, and consistently outinvest their generalist competitors in R&D, specifically related to skin and hair biology.
So no single competitor matches their breadth across all 4 channels.
And all of them benefit from that one massive R&D engine.
And the competitive moat isn't static, it is actively widening. We see clear evidence of management understanding the threats of the future and aggressively allocating capital to counteract them.
Like with beauty tech.
Exactly. They are moving rapidly into beauty tech. This means integrating AI to analyze consumer data for hyper-personalized product recommendations, developing specialized tools for personalized diagnostics.
Even manufacturing on demand.
Right. This is about capturing the next generation of consumer customization and ensuring they are technologically relevant when the digital native brands try to attack their core franchises.
And beyond internal investment, their mergers and acquisition strategy is a masterclass in strategic portfolio management.
They're not just buying growth for the sake of it.
No. They aren't acquiring businesses just to add bulk. They are filling specific, high-growth, high-margin niche gaps.
Like CeraVe.
Take the acquisition of CeraVe, which gave them the crucial bridge into the physician-recommended dermatological space in the U.S., where they had previously been weak.
A huge gap to fill.
Or the acquisition of Aesop, which significantly enhances their premium, ethically focused, high-growth luxury niche. These are highly rational deals designed to enhance the quality and resilience of the overall portfolio.
Strengthening the moat, not just adding volume.
Exactly.
You mentioned the talent factory earlier, and this brings us to a crucial, often ignored organizational edge: culture as an asset.
Right.
From an employee perspective, the company's internal culture is intensely mission-focused. They are driven by innovation. And that high engagement rate, around 79%, isn't just a feel-good number.
No, that engagement rate sustains the R&D engine. To maintain a technological edge, you have to attract and retain the world's best scientific, chemical, and digital talent.
And if your culture is seen as the best place to do that work.
Then the best scientists choose L'Oréal over a generalist FMCG competitor, which in turn ensures the billion-euro R&D budget is being deployed by the absolute sharpest minds in the industry. It's another compounding advantage.
Okay. We've thoroughly established the quality of the business and the strength of its competitive barriers. Now we have to look at the quality of the people running the organization, the stewards of this massive competitive advantage management stewardship and financial quality.
The leadership philosophy here is fundamentally owner-oriented and long-term.
They're not thinking quarter to quarter.
Not at all. The current CEO, Nicholas Hieronymus, and his predecessor, Jean-Paul Agon, have consistently upheld the sacred vision of being a beauty pure player.
Resisting the urge to diversify.
Yes, they resist the temptation of unrelated diversification, which is a trap that has plagued many of their peers. This singular focus ensures that all resources, time, capital, and talent are laser-focused on the beauty consumer.
And this singular commitment is underpinned by one of the most intellectually rational organizational designs in the corporate world.
They operate what they call a strategically centralized but operationally decentralized model, which they define as freedom within the frame.
Okay, let's unpack that. It's critical to their agility.
It is. Global strategy, the core R&D portfolio, and overall financial guardrails are set centrally in Paris. That's the frame.
Got it.
But local teams, say in Brazil or Shanghai, are empowered with radical autonomy, the freedom to adapt marketing campaigns, distribution partnerships, and even product formulations
To suit local tastes.
hyper-specific regional consumer tastes and regulatory environments.
Mm.
This is a crucial sign of non-hubristic leadership.
Right.
They understand that a Parisian lab cannot dictate what a consumer in Seoul or São Paulo needs.
So they trust local expertise and adapt to the world rather than forcing uniformity.
Exactly.
And this organizational stability and long-term focus is fundamentally cemented by the insider ownership structure, which is an intangible moat in itself.
Absolutely. When we talk about shareholder alignment, L'Oréal is in a class of its own.
The family ownership.
The Bettencourt Meyers family, descendants of the founder, holds a massive minority stake, roughly 34.76%.
And Nestlé is still in there too.
On top of that, Nestlé holds another substantial block, about 20.14%. When you add those two major shareholders together,
That's over half the company.
over 50% of the company is held by long-term, multi-decade investors.
And what's the practical implication of that?
It means management is insulated from the whims of short-term, quarterly activist investors. They can confidently announce that billion-euro R&D budget and invest in beauty tech platforms that won't yield profit for 5 years.
Without being punished for it.
Without fear of being challenged to cut costs for quick returns, this structure enables genuine long-term compounding.
And their capital allocation track record demonstrates that rationality. They consistently prioritize the core moat.
R&I and beauty tech, number one.
And their M&A strategy, as we discussed with CeraVe and Aesop, is highly strategic and gap-filling. They focus on deals that strengthen the long-term structure.
And when it comes to returning capital,
They maintain a progressive dividend policy and execute share buybacks precisely and rationally, evidenced by a slow, consistent decrease in shares outstanding over time. They deploy cash efficiently. They pass the test.
okay, so let's move to the hard numbers. The financial architecture is built on a foundation of exceptional consistency.
Their machine.
L'Oréal routinely outperforms the broader beauty market, achieving consistent sales growth and margin expansion due to their pricing power and strategic diversification.
And this brings us to the ultimate hallmark of a wonderful business, the return on invested capital, ROIC.
L'Oréal's trailing ROIC is approximately 13.98%.
So nearly 14%.
Right. Now, for the informed investor, the story isn't the number itself, but the spread. We estimate the cost of capital to be around 7 to 9%.
So they're earning well above their cost.
Consistently and significantly higher. This tells us something profound. Every dollar they reinvest into the business in a new lab, a new factory, or a massive marketing push generates nearly double the cost of that capital.
That's the definition of a wide moat business that efficiently compounds wealth.
It is. The internal investment decisions are generating genuine economic value.
And when we look at the quality of those earnings, we turn to free cash flow, FCF conversion. This ratio tells us how much of the reported accounting profit actually turns into usable cash.
Cash in the bank.
Exactly. L'Oreal's FCF to net income ratio sits well above 100%, currently around 120.9%.
That is stellar. What does this mean in practical terms?
It indicates the business is incredibly capital light. They don't require massive ongoing capital expenditures relative to their profits, giving them tremendous cash flexibility.
So they have a war chest.
A huge one. Generating more cash than their reported accounting profit means they have substantial discretionary cash flow that the aligned management team can deploy rationally for R&D, M&A, or shareholder returns.
Okay, and the final piece of the financial puzzle, the balance sheet.
The balance sheet strength rounds out the picture of an untouchable financial position. Their net debt to EBITDA ratio is extremely prudent.
How low is it?
Sitting around 0.4 times.
That's negligible financial risk.
It's basically nothing. If you are comparing this to highly leveraged competitors, L'Oreal has maximal flexibility. During global economic uncertainty or market panics, they have the financial power to make strategic, counter-cyclical moves.
Like snapping up distressed assets.
Or increasing R&D spending while competitors cut back, or simply increasing share buybacks. They have stability when others face existential threats.
Okay, so we have established beyond a reasonable doubt that we are looking at an objectively wonderful business.
Built on unparalleled competitive and financial strength.
Now we come to the inevitable hurdle, the final barrier to achieving stellar long-term returns. Valuation.
Right. We acknowledge the premium valuation right out of the gate, that LTM PE of approximately 32 times.
And the market correctly justifies this because L'Oreal is a rare combination.
It's a hybrid.
It offers the resilience and non-cyclical demand typically found in a consumer staples company,
blended with the high margins and growth potential traditionally associated with a luxury goods operator.
So you get low business risk, high ROIC, and a clean balance sheet. And that confluence commands a premium price.
But this is where we have to re-emphasize the critical, painful lesson in long-term investing.
The triumph of value over quality at the wrong price.
Exactly. L'Oreal is a wonderful business, but no matter how perfect the operation, if you overpay, your returns will be muted.
If, for example, you had chased this stock when its PE was inflated to 45 times, even if the company grew earnings by 8% annually.
A future compression of the multiple back to 30 times would essentially consume all of your earning growth,
leaving you with mediocre or zero returns over 5 years.
The business can perform flawlessly, yet the investor performs poorly simply because they overpaid.
The price paid is the anchor on which long-term returns are fixed.
So, given that a traditional low multiple value margin of safety is simply impossible here, where do we find our entry point? We must be opportunistic.
Our margin of safety has to be found in a temporary setback that does not permanently impair the earning power of its brands or its R&D engine.
We're looking for volatility, not disaster.
Right. We need to watch for a significant geopolitical or trade shock, especially since they rely so heavily on major markets like North Asia.
So, a temporary slowdown in China or a trade friction in the U.S.
that reduces sales for a quarter but leaves the core structure intact. That would be a great opportunity.
We also look for company-specific but short-lived issues. Maybe a major product recall, a marketing misstep.
A temporary supply chain shock.
Right, something that causes a short-term stock drop but doesn't fundamentally break long-term consumer trust in a brand like Lancôme or CeraVe.
Those moments where perception diverges temporarily from reality are the only times this stock is likely to trade at a genuinely attractive multiple.
And of course, the general market panic.
When credit crises hit or rates surge, the market often indiscriminately sells off all high-quality, high-multiple names to raise cash.
And in those periods where the underlying fundamentals are unchanged but the price drops dramatically,
that's the opportunity to purchase compounding power at a discount.
Okay. Now, let's flip the analysis and acknowledge the permanent impairment risks. The things that could fundamentally break the bull case regardless of the price paid.
The bear case.
The first major threat is the digital disruption risk. L'Oreal is investing heavily in beauty tech, but they are a massive, slow-moving organization compared to digitally native startups.
So the risk is that they're too slow.
The risk is the failure to integrate those new technologies from AI recommendation engines to customized digital distribution fast enough, and failing to adapt to the rapid microbrand disruption cycles driven by platforms like TikTok and Instagram.
Where a small, agile brand can gain massive traction overnight.
Exactly. And L'Oreal's traditional retail-heavy distribution structure might be too slow to react or acquire them before they become a meaningful threat.
But the ultimate existential risk is the loss of the R&I lead. The entire fortress is built on its superior science.
So if that crumbles, everything crumbles.
If L'Oreal permanently fails to anticipate and adapt to major, irreversible structural shifts in material science, their scale becomes a liability.
What kind of shifts are we talking about?
Specifically, we are talking about green sciences and personalized synthetic biology.
Okay.
Green sciences refers to the industry shift toward sustainable biotech-derived ingredients, fermented compounds, and highly complex bioengineered molecules.
That replaced traditional petrochemical synthesis.
Yes. If L'Oreal's 4,000 researchers are focused on optimizing old chemistry, while a more agile competitor perfects large-scale synthetic biology for custom skincare formulations,
Then L'Oreal's entire scientific foundation risks becoming obsolete. They would be solving the wrong problems.
and tied to this, the rising risk of brand irrelevance reputation loss.
Especially with younger consumers.
The younger, digitally vocal, consumer-based Gen Z demands extremely high standards of sustainability, ethical sourcing, and transparency.
So a major scandal would be devastating.
The risk of a major, unrecoverable ethical or environmental scandal that permanently breaks that trust is high, especially for a company with such a massive global footprint. It could rapidly erode brand equity across multiple divisions.
This is why it's imperative to engage in a red team challenge where we invert the bull case.
We need to present the most compelling bear scenario, questioning the very durability we've analyzed.
Right. What if the durability L'Oreal exhibits is simply an investment in the past, designed for a market that is about to disappear?
We have to imagine the blockbuster scenario. L'Oreal becomes the DVD by mail service in a world that has already moved to streaming.
The core argument for owning L'Oreal relies on scale and brand equity, but this could be rapidly impaired by truly disruptive, personalized technology.
So let's paint that picture.
Imagine a new, science-driven startup backed by massive private capital. This startup uses proprietary AI to analyze an individual's unique skin or hair microbiome.
The living microbial layer that determines skin health.
Yes, perhaps even analyzing their genetic markers. It then uses precise 3D printing or microdispensing technology to create a customized, superior product at home.
In a small appliance that costs $500.
Right. In that world, the personalized product is scientifically proven to be better than anything L'Oreal can mass manufacture in a centralized factory.
Suddenly, L'Oreal's massive reliance on physical retail, traditional distribution, and generalized brand marketing across 37 brands becomes a critical liability.
Their greatest asset becomes an anchor.
A heavy anchor of obsolete distribution centers and old chemical factories. Furthermore, that billion-euro R&D budget is suddenly aimed at optimizing jar packaging.
When the market has moved to personalized at-home biotech,
In this scenario, paying the current high premium price would be investing heavily in a durable past, designed for a mass-market consumer that may not exist in 15 years, rather than investing in a revolutionary future.
okay, that's a chilling scenario. Let's pivot back to the positive side. Assuming management successfully navigates those risks, what are the catalysts that could unlock immediate value if an investor buys during a dip?
I think the biggest one would be them proving they can win in tech.
The successful scaled commercialization of their beauty tech diagnostics and customized production capabilities would be a game changer.
If they can successfully roll out personalized beauty platforms that generate a new, high-margin revenue stream, like a subscription for custom serums,
It validates the whole strategy.
it fundamentally validates their massive R&D investment and widens the moat against that AI 3D printing threat by meeting it head-on.
We should also watch for highly rational and accretive M&A that is focused on future technology.
Yes, if they make a major, strategically perfect acquisition in advanced biotech skincare, perhaps acquiring a company that has mastered microbial formulation, that could be a huge signal.
Or if they divest a lower margin, non-core legacy division.
It could lead to immediate margin expansion and a higher return on invested capital, prompting a reassessment of their intrinsic value.
Okay, but let's bring it to the most critical second level of thinking.
Right. The market consensus, the first level, sees the visible assets, the brands, the high ROIC, the billion-euro R&D budget.
But our key insight is different.
Our key insight, the thing that separates L'Oreal from a traditional static incumbent, is the enduring value of the decentralized freedom within the frame culture.
We mentioned this organizational philosophy earlier, but it deserves the spotlight as the ultimate organizational moat.
It does.
How does this organizational structure specifically function as a defense against the digital native threat?
Because it ensures adaptability at scale. The ability of a massive global company to remain agile and entrepreneurial, to constantly self-renew its product portfolio through local adaptation and rapid testing, is not a minor footnote. It is the organizational moat.
So it's how they stay nimble despite their size.
It's how they digest those strategic acquisitions like CeraVe, integrate new beauty tech divisions, and adapt to regional trends faster and more efficiently than their centralized generalist rivals.
This unique culture compounds organizational advantage beyond what simple PE ratios capture.
It is the intangible glue that ensures the tangibles, the R&D, and the brands work efficiently and remain relevant in a fragmented, changing world.
It is the reason why L'Oreal can exist in 150 countries and still feel local in its execution.
So that brings us to the synthesis and our final verdict on this deep dive.
We have confirmed the fundamental quality of L'Oreal. It possesses an unmatched wide moat anchored by a unique, diversified portfolio across all consumer touchpoints and superior industry-leading R&D.
The financial fortress is undeniable.
High, consistent ROIC, minimal debt, and aligned leadership focused on being a beauty pure player amidst powerful structural tailwinds.
The analysis confirms L'Oreal is truly a wonderful business.
Yeah.
But
There's always a but.
the investment hinges entirely on the price paid today and management's ability to maintain that R&D and organizational lead against the rapidly emerging digital and biotech disruption threats.
They can't stumble.
L'Oreal must continuously execute flawlessly on innovation and organizational adaptability to justify its premium. It is a stock that you buy during temporary operational weakness or broad market panic, not during euphoria.
Okay, to leave you with a final provocative thought, building on that second-level thinking regarding the organizational moat, we discussed the decentralized freedom within the frame model.
And we want to challenge you to move beyond the P&L statement and research how L'Oreal maintains that internal agility.
So not just that they do it, but how they do it.
Exactly. If organizational design is the ultimate moat against disruption, because it ensures the company can react to the AI-pod 3D printing threat, how do they actually measure and protect that internal entrepreneurship?
What metrics do they track internally to ensure local managers are truly acting with autonomy?
And how do they prevent the centralization from strangling the freedom? This is the factor that ensures that billion-euro R&D budget is spent correctly, solving the right problems for the future.
This is the next frontier of due diligence for a long-term compounder.